Welcome to our deep dive on rebuilding retirement after a mid-career financial crisis. If you're around 39 to 40 and sitting on roughly $30,000 for retirement, this video is your action plan to turn that small head start into a comfortable retirement. We'll move step by step with a clear, aggressive blueprint that prioritizes savings rate, compounding, and smart decisions around your mortgage. Let's get into it. In this agenda, we'll begin with the reality of starting over near age 40. Next, we'll introduce the three-step blueprint that forms the core of your plans. Then we'll quantify your savings rate and show the compounding strategy. After that, we'll tackle the mortgage versus investing decision. We'll convert everything into a concrete 90-day action plan, add risk controls, test your understanding with a pair of quick quizzes, and wrap with clear takeaways. Before we start, this video is for educational purposes only. It is not individualized financial, legal, or tax advice. Your personal circumstances, employer plans, tax bracket, state rules, risk tolerance, and goals matter. Please consult a qualified fiduciary financial advisor or tax professional before acting. The reality is that at 39 years old, time is still on your side. Even if you drained accounts to survive career volatility, you have a meaningful runway to rebuild. The mindset shift is to move from survival to aggressive accumulation immediately. The small balance is not the story. The savings rate and consistency are. With 25 or more years, the compounding window is substantial. You are not starting from zero. That $30,000 is your base layer, and what matters most now is how aggressively you add to it. The coming 5 to 10 years are leverage years, where your contributions do the heavy lifting. Build a system that automates deposits, stays diversified, and keeps fees low through index funds. Remember the core principle. A high savings rate, combined with time in the market, is more powerful than trying to time the market perfectly. The blueprint starts with an aggressive savings rate. Target at least 20% of your gross income and treat every raise as dedicated retirement fuel. Next, harness compounding by investing consistently into diversified, low-cost index funds and avoiding market timing. Finally, address the mortgage question with clear priorities. If your mortgage has many years remaining and is at a reasonable rate, prioritize tax-advantaged investing before accelerating principal payments. Follow the flowchart order. Capture your 401k match, then HSA if eligible, then IRA, then increase 401k, and use taxable accounts for overflow. Here is your first 90 days. First, establish a two-account cash system, a checking account for bills, and a high-yield savings account for an emergency fund of 3 to 6 months of expenses. In weeks 1 and 2, make sure you capture the full 401k match. In week 2, if eligible, open an HSA and invest the balance rather than letting it sit in cash. In weeks 2 to 3, open or fund a Roth or Traditional IRA based on your tax situation, and invest in a broad market index fund. By week 3, automate contributions so your combined rate reaches at least 20% of gross income. In week 4, set a target allocation, for example, 80 to 90% stocks and 10 to 20% bonds depending on your risk tolerance. In week 5, consolidate orphaned accounts and consider rolling over old plans where appropriate. In week 6, enable automatic rebalancing or set quarterly calendar reminders. In weeks 7 to 8, open a taxable brokerage account for overflow after maximizing tax-advantaged options. Finally, in weeks 9 to 12, route raises, bonuses, and refunds into investments to maintain momentum. Let's quantify your savings rate. If your income is $120,000, a 20% target equals $24,000 per year, or about $2,000 per month. If that feels steep, use the 1% rule by increasing your savings rate by 1% of pay each month for a year. Automation makes this sustainable. Split direct deposit and schedule transfers so the system funds your 401k, IRA, or HSA, and then taxable accounts in order. Also, control lifestyle creep by sending raises and windfalls into investments first. This table outlines guideline savings rates by income bracket. For $80,000 to $100,000, start around 15% and stretch to 20% or higher by using the employer match and IRA, then increasing 401k. From $100,000 to $150,000, try for 18% and stretch to 25%. Adding an HSA if eligible. From $150,000 to $250,000, target 20% and stretch to 30%, maximizing all tax-advantaged accounts with taxable overflow. Above $250,000, begin near 22%, and stretch into the 30s to front-load early years. These are guidelines, not prescriptions. Compounding rewards consistency. Time in the market beats timing the market by a long shot. Diversify through broad index funds to capture market returns while keeping costs down. Rebalance on a schedule to maintain your target allocation and avoid emotional trades. As you reach age 50, take advantage of catch-up contributions to accelerate your final approach to retirement. Now let's tackle the mortgage. If you still have about 18 years remaining and your mortgage rate is moderate, accelerating payments often delivers a lower expected return than investing in diversified portfolios, particularly when using tax-advantaged accounts. The amortization schedule steadily reduces interest over time, while invested dollars can compound. Therefore, prioritize tax-sheltered investing before making extra principal payments, unless your rate is very high or your risk tolerance is extremely low. Here is a practical comparison. Investing extra funds offers higher expected long-term growth, liquidity, access to tax-advantaged compounding, and a more diversified balance sheet. Prepaying the mortgage provides a guaranteed return equal to the interest rate, emotional comfort from being debt-free sooner, lower required cash flow in retirement, and simpler budgeting. If your mortgage rate is low to moderate and you have a retirement shortfall, the math usually favors investing, but personal preferences and risk tolerances still matter. Quiz time. Which order best prioritizes where each new dollar should go for most mid-career rebuilders? Option A. Extra mortgage principal, then taxable brokerage, then 401k match. Option B. 401k up to match, then HSA if eligible, then IRA, then increase 401k, then taxable brokerage. Option C. Cash savings only until 12 months of expenses, then invest. Option D. Individual stock picking before index funds. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. First, capture the employer match in your 401k. Next, if you are HSA eligible, fund and invest the HSA. Then fund an IRA. Increase your 401k toward the maximum, and only after that direct overflow to taxable brokerage accounts. Risk management supports your plan without derailing growth. Maintain 3 to 6 months of expenses in a high-yield savings account. And ensure insurance is in place, disability coverage, term life if dependents rely on your income, and solid health insurance. Rebalance periodically and resist fear and greed. Steer clear of high-fee, opaque products that siphon off your compounding. This mind map centers on the retirement rebuild. It branches into 4 pillars: a cash buffer for 3 to 6 months of expenses in high-yield savings, tax-advantaged accounts including the 401k match, an invested HSA and IRA, increasing the 401k to the maximum, and catch-up contributions starting at age 50. A taxable bucket for broad index funds with automation and overflow from raises or bonuses, and risk management through appropriate insurance, scheduled rebalancing, and keeping fees low. Together they form a cohesive system. Second quiz. Which statement about compounding is most accurate for a 25-year horizon starting at age 39? Option A. Waiting for the perfect entry point usually improves results. Option B. Short stints out of the market rarely matter. Option C. Consistent, automated investing typically beats market timing attempts. Option D. Fees do not matter if returns are high. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is C. Consistent, automated investing tends to outperform attempts to time the market. Missing even a handful of strong market days can materially reduce long-term results. Keeping costs low and staying invested are the reliable drivers of compounding. Here are the key takeaways. First, move from survival to aggressive accumulation by targeting a savings rate of 20% or more. Second, follow the priority order for tax-advantaged accounts. Third, allow compounding to work by staying invested, diversifying, rebalancing, and keeping costs low. Fourth, if your mortgage rate is moderate and your retirement gap is significant, prioritize investing over prepayment. Fifth, automate contributions and route raises and windfalls to investments. Finally, protect the plan with an emergency fund and appropriate insurance. To pull it all together, you still have time. but you need intensity right now. Small, consistent, automated actions create big outcomes. In most cases, invest first and consider mortgage prepayments later. Stick to your plan through volatility and rebalance on a schedule. Your comeback is built with contributions and discipline, not guesses. Thanks for watching. If this video helped you, please like, share it with someone who needs a financial reset, and subscribe for more practical playbooks. Tell us in the comments what your very next action will be today toward your retirement rebuild.